Hi everyone, I'm Jash Bhatia and this is my Fin332 Trading in Financial Markets Final Report. I answered 3 out of 4 questions covering the Islamic fund tournament behavior, the buy right option strategy, and the bond portfolio management in 2026. So I'll start with the tournament behavior in Islamic funds. So in question 1, I studied approximately 20 Indonesian Islamic mutual funds from Jan 2015 to December 2024 to test whether tournament behavior exists. So the idea that top performing funds reduce risk in the second half of the year to protect their rankings, while the underperforming they take up more risk to catch up. So I used Dr. Ramya's 2012 non-parametric methodology, and I found clear evidence of tournament behavior. So the top 5 funds, they cut their second half risk by an average of 6.4 to 6.5% percentage points, and Lagarde showed moderate risk increases but less extreme than theory predicts because Sharia constraints ban leverage, short selling, and they also are speculative instruments limiting how much risk that the managers can add. So the best performer was TRIM Saria Saham with a Sharpe ratio of 5.88 in 2019. My tournament rotation strategy, buying Lagardes in July and exiting by December, it also returned an overall profit of IDR of 3.25 billion, and I started with a capital of IDR 10 billion with a Sharpe ratio of 0.74. And it also suggested that the Indonesian Islamic fund market does not fully satisfy the semi-strong efficient market hypothesis. And I'll move on to CAF 3, where I tested whether buy right strategy or covered calls violates the efficient market hypothesis on the Australian Stock Exchange. I built covered call portfolios on 5 large ASX stocks: BHP, CBA, CSL, Westpac, and ANZ, and I compared them to the S&P ASX 200 and the S&P 500 from Jan 2023 to March 2026. The results were clear. The BWS produced a Sharpe ratio of 0.52 versus 0.18 for outright equity, which is a 189% improvement in risk-adjusted returns. Jensen Alpha's was 0.034, meaning the strategy earned 3.4% year above what CAPM would predict. So in 12 simulated demo trades, I made a net profit of Australian dollars 3175 with an 83% win rate. So only 2 trades lost money, and both were due to sharp underlying stock drops where the premium only partially offset losses. So in conclusion, the BWS partially challenges semi-strong EMH through it, and it also reflects volatility risk premium. So where implied volatility is consistently higher than realized volatility rather than true market efficiency. And moving on to the last question, in question 4, I built a 30 bond global portfolio worth across 30 million US dollars across sovereigns, investment grade corporates, and emerging market bonds, and asked, is it too late to invest in March 2026? So the backdrop is tough. The Middle East, the oil disruptions pushed WTI crude to approx 95 to $100 a barrel. The Fed delayed rate cuts, and the US 10-year yield sits at 4.44%. But my answer is it's not too late. You just need skill, not passive bets. My portfolio had modified duration of 7.46 years and a portfolio convexity of 98.7. I used a mix of buy and hold immunization during matching and active strategies like interest rate anticipations and bond swaps. The portfolio returned 2.52% in the first quarter of 2026, outperforming the Bloomberg Global Aggregate benchmark by 28 basis points. I also reflected honestly on my execution failures. I over leveraged on Japanese JGBs and lost approx 3.4 lakh US dollars, and held the Brazilian bond too long without a stop loss, and was overly concentrated US treasuries on early on. So these were the biggest lessons. So the takeaway in 2026: bonds reward portfolio selection, discipline, not just passive holding. So overall, all the 3 answers point to one theme: markets have inefficiencies, but not only disciplined evidence based strategies can consistently exploit them. Thank you, everyone.